Welcome back to the deep dive. I have to be honest with you. I was reading through the stack of research we have for today, and I just had this overwhelming feeling.
Hmm.
If I pitched this story to a Hollywood studio, like if I walked into Netflix and slammed the script on the table, they would laugh me out of the room.
Oh, 100%.
They'd just say, this is too much. It's too on the nose. The irony is like way too thick.
Oh, absolutely. It feels like a morality play written by some, really cynical satirist. It's almost literary in how perfect the rise and fall is.
It is.
If you wrote this as fiction, people would say the villain is too cartoonish and the plot twists are they're too convenient.
Exactly. It's ridiculous. But as we know, reality is often stranger and, frankly, much stupider than fiction.
Yeah, that's the truth.
Today, we are talking about a magic trick. But not the fun kind. We aren't talking about pulling a rabbit out of a hat or, guessing your card.
No, this is the dark arts. This is the kind of magic trick where $32 billion, and let's just pause on that number for a second.
We have to.
$32 billion just vanishes into thin air.
Oof, gone. And the timeline. That's the part that really, really messes with my head. We aren't talking about a slow, agonizing decline over a decade.
Well,
This isn't Blockbuster Video slowly fading away while we all switch to streaming. It's not Sears losing touch with the modern shopper over, 20 years.
This is vertical. This is a cliff, an absolute cliff.
We are talking about a financial empire that was standing tall, looking down on the world in 2022. It was the golden child. It was the future. And then, mere days later,
Dust.
dust. Just absolute rubble.
It's the velocity of the collapse that just gives you whiplash. It's shocking. 1 minute you're the king of the world, trusted by politicians, celebrities, millions of regular people just trying to invest their savings.
Right.
And the next minute, the lights are off, the doors are locked, and the lawyers are swarming everywhere.
Exactly. And the subject of today's deep dive is, of course, the one, the only, FTX.
The 3 letters that became a 4-letter word in the financial world.
Seriously. FTX was one of the absolute titans, the largest, or at least one of the largest financial empires in the entire crypto space. But here's the angle that I find so fascinating and honestly kind of darkly funny if you can get past the tragedy of it all.
Okay, what's that?
This wasn't just a collapse. This was the collapse. We've seen crypto exchanges fail before. We've seen scams. We've seen rug pulls. But
This is different.
this was the Titanic. But, and stick with me here, imagine if the captain of the Titanic didn't just hit an iceberg by accident.
Okay, I'm with you.
Imagine if the captain saw the iceberg, turned to his first mate and said, hey, I bet you $10 I can drift around that thing, and then just steered right into it because he thought he was smarter than the ice.
Wow. That's a terrifyingly accurate analogy. And I think what makes it the Titanic isn't just the size of the ship, but the reputation of the ship.
Yes.
The Titanic was famous because it was unsinkable.
Right. And FTX was marketed the exact same way. If you look at the source material we have today, which, by the way, is a fascinating postmortem on the whole event, it highlights something absolutely crucial. FTX wasn't marketed as the Wild West of crypto.
Yeah.
It wasn't the place for, the chaotic anarchist hackers in Guy Fawkes masks.
No, quite the opposite. And
Yeah.
that was the genius of their branding.
Yeah.
They looked at crypto, which was scary and confusing to most normal people, and they said, we are the safe space.
The adult in the room.
We are the adult in the room.
Yeah.
It was pitched as the bridge to the mainstream. If your grandmother was going to buy Bitcoin,
Yeah.
she wasn't going to use some shady USB drive in a back alley or some website hosted in a basement. She was going to use FTX.
Yeah.
Because FTX had the commercials, the suits, the compliance teams. They wore the costume of legitimacy.
The irony is so thick you could cut it with a knife. It was supposed to be the entity that legitimized the entire industry. It was supposed to prove that crypto could be safe, regulated, and just normal. And instead, it became the poster child for why people are terrified of this industry.
It's the paradox of trust. The more someone tells you I am the safe option, the more we tend to stop checking if they're actually safe.
Good point.
We outsource our due diligence to their marketing department. And that, I think, is really the mission of our deep dive today.
Yeah, let's talk about that, the mission statement here. We are going to unpack this text to understand how this happened. How did we get here? Specifically, how did a guy who was painted as a math genius, someone who preached ethics, someone who said he was doing it all for the greater good, end up overseeing one of the biggest breaches of trust we've ever seen?
And, maybe more importantly for everyone listening, we need to answer the question. Why is trust without verification Such a dangerous, dangerous game.
Yeah.
Why do we keep falling for the trust me bro strategy when there are billions and billions of dollars on the line?
It's going to be a wild ride. We've got billions of dollars, Super Bowl ads, secret hedge funds, and a guy playing video games while the world burns. So, let's get into it.
Let's do it.
All right, section 1. We have to start with the emperor himself, the man at the center of the crater, Sam Bankman-Fried. Or, SBF, as everyone called him.
The central figure.
Yeah.
You really can't tell this story without understanding the character profile here, because the character was the product. That's what he was selling.
And what a character profile it is. The research we have describes him with 3 very specific words: young, brilliant, and awkward.
And let's be real, that awkward part is doing a lot of the heavy lifting in this narrative, isn't it?
It really is. I mean, think about the typical image of a financial mogul. Close your eyes and picture a guy running a $32 billion company. You think of Gordon Gekko, right?
Sure. Slick back hair.
Slicked back hair, $3,000 suit, aggressive, shark-like. You think of a guy who eats steak for breakfast and just yells at people on the phone.
Right. Wall Street. The 80s power broker stereotype.
But SBF, he was the anti-deco. He was the guy in the t-shirt and the cargo shorts, the guy with the messy afro who looked like he just rolled out of bed.
And he's playing League of Legends during pitch meetings with major investors.
Exactly.
And see, that's where the math genius trope comes in. It's a very specific cultural archetype we have right now, especially in tech and finance. We've been trained by movies, the Social Network or The Big Short, to believe that if someone is socially awkward, dresses poorly, and seems distracted,
Then they must be a genius.
they must be operating on a higher plane of intelligence.
Oh, totally. We think, oh, he's too busy thinking about 11-dimensional chess to, comb his hair.
Exactly. If he walked in wearing a tailored suit, you'd immediately think, okay, he's a salesman. He's trying to sell me something.
Yeah.
But if he walks in wearing a hoodie and looking at his shoes, you think, he's a visionary. He doesn't care about worldly things like looking professional. He only cares about the code.
It's almost like a costume, isn't it? I mean, I'm not saying he wasn't smart. The source says he was brilliant in many ways. But the presentation of that brilliance, it just disarmed people. It made these seasoned investors feel like they were in the presence of an oracle.
It lowered their defenses. It's a heuristic. It's a mental shortcut. Messy genius equals trustworthy innovator. And that brings us to the ethics shield. This is a huge part of the text we're looking at. He didn't just present himself as smart. He presented himself as good.
The altruist.
Right. He was the face of effective altruism in the crypto world. He was famous for this whole philosophy of earning to give. And the pitch was incredible.
It's a great pitch.
I'm going to make billions of dollars not to buy yachts or islands, but to save the world, to prevent pandemics, to help the poor.
Which is a fantastic sales pitch. Because if I'm an investor or even just a regular user and I give my money to a shark, I know I have to watch him. I know his incentive is pure greed.
Right. You're on guard.
But if I give my money to a saint, well, saints don't steal, right? Saints aren't trying to rip me off.
That's the aha moment.
Right.
The persona was a key part of the trap, whether it was, fully intentional manipulation or just a personality quirk that he leaned into. It worked as camouflage. People wanted to believe in the benevolent genius. We are desperate for that narrative. We want the guy who is smarter than us and nicer than us to take the wheel.
It's the superhero complex. We wanted Tony Stark, but without the ego. Or maybe with a different kind of ego.
A humble brag ego.
Yeah.
A performative humility. I'm just a nerd trying to help. It made him incredibly effective at gathering support from people who usually would have been much, much more skeptical.
Oh, absolutely.
You had VCs who usually tear founders apart for having a single typo in their slide deck.
Yep.
And they were giving this guy hundreds of millions of dollars while he was literally clicking a mouse, killing monsters in a video game. It's unbelievable.
And boy, did he gather support. Which leads us perfectly into section 2, the illusion of success. Or, as I like to call it, if it's on a billboard, it must be true.
The rocket ship growth.
Yeah.
The source material emphasizes this incredible speed.
It wasn't just growth, it was a straight-up explosion. We're talking about a company that went from being kind of obscure to completely ubiquitous in a heartbeat. Let's list some of the accolades mentioned in the source. We had stadium naming rights. The Miami Heat played in the FTX arena.
Which is not cheap. That is a massive, massive check to write.
We had celebrity endorsements, A-listers, Tom Brady, Giselle, Steph Curry, Larry David, people you trust, people you invite into your living room through your TV.
And the crown jewel of them all, Super Bowl ads.
The Super Bowl ad, that is the pinnacle of "we have arrived." You don't buy a Super Bowl ad if you're running a Ponzi scheme, right?
Well, that's the logic we all use.
Yeah.
And it's the humorous, cynical take on capitalism. We assume that the cost of visibility equals the proof of legitimacy.
That's a great way to put it.
They spent $7 million on 30 seconds of airtime.
Yeah.
They must have the money. The NFL wouldn't let a scam air during the Super Bowl, would they?
It's circular logic. They have money because they spent money.
Exactly. But it works. It creates what we call social proof. And the source touches on this smart money fallacy. Investors rushed in, billions of dollars followed. And why did they follow? Because other people were following.
FOMO, fear of missing out.
It's institutional FOMO. It's not just the guy on Reddit. It's the biggest funds in the world. If Sequoia is in, if BlackRock is in, well, who am I to question it?
Right.
The logic becomes, Sequoia must have checked the books. BlackRock must have done their due diligence.
But Sequoia thought BlackRock checked the books, and BlackRock thought Sequoia checked the books.
Precisely. It's a circle of people just nodding at each other, assuming someone else did the homework. From the outside, the structure looked absolutely solid. It looked like a fortress.
It's like looking at a movie set. From the front, it's this beautiful Victorian mansion. It looks livable. It looks real. But if you walk around the side...
Just plywood and 2x4s and duct tape holding it all up.
And that's the transition, isn't it? As with all magic tricks, the Super Bowl ads, the magazine covers, the quirky interviews, that was all the distraction.
Yeah.
That was the magician waving his left hand so you wouldn't look at what his right hand was doing.
Because behind the scenes, as the text says, something was very wrong. The foundation was rotting while they were still adding a new penthouse on top.
So let's get into the mechanics of the collapse. Section 3, the hidden mistake. Although, calling it a mistake feels a bit generous, doesn't it?
It does.
Oops, I accidentally committed massive fraud.
It does. It implies like a clerical error. The source phrases it in a really interesting way. It says, in my opinion, the real problem wasn't crypto, it was control.
Explain that, because a lot of people blamed the technology. They said, see, crypto's a scam, Bitcoin is fake. But the source is arguing it wasn't the tech itself.
Right. And that's a key distinction. Blockchain technology, in theory, is about transparency and decentralization. It's supposed to be an open ledger. Everyone can see the math.
Okay.
But FTX was a centralized black box. It was a database on a private server controlled by a handful of people in a penthouse in the Bahamas. And the issue wasn't the coins. It was who controlled the ledger, who could edit the numbers.
And this brings us to the entity that was hiding in the shadows, Alameda Research.
The secret pocket. The ghost in the machine.
So, for the listener who might not know the intricate corporate org chart, can you break down the relationship between FTX and Alameda Research? Because this right here is the smoking gun.
It's actually quite simple, which is why it was so incredibly dangerous. FTX was the exchange. That's where you, the customer, went to buy and sell crypto.
Right.
You deposit your money there. It's supposed to be a vault.
Like a bank. Or a brokerage, like a Fidelity or a Schwab.
Exactly like a bank.
Yeah.
You put your money in, it sits there safely until you want it back. Alameda Research, on the other hand, was a hedge fund, a proprietary trading firm.
Sure.
Their job was to make bets. High-risk, high-reward bets on the crypto market.
Okay, so you have a bank and a gambler.
Correct. Now, normally, in the regulated financial world, these two things should be completely, totally separate. There's a wall of fire between them.
There better be.
A bank doesn't take the money from your savings account and give it to a guy at the blackjack table.
I would hope not. If I put money in my savings account, I expect it to be boring. I don't want it to be exciting. That's the whole point.
But here is the cardinal sin, the smoking gun in the source text. They were both owned by the same founder. SPF. And the action that caused the entire collapse. FTX secretly moved customer money to Alameda.
Wait, let's just pause on that. They took the money that customers thought was sitting safely in the vault and moved it to the gambler.
Yes. They essentially created a backdoor in the code, a special privilege, that allowed Alameda to borrow effectively unlimited amounts of money from the exchange customers without any collateral.
The humorous analogy here, if you can call it that, is exactly what you said earlier. Imagine you walk into your local bank, you deposit $1,000 for your kid's college fund, and you walk out feeling responsible and secure.
Yep.
5 minutes later, the bank manager takes that cash out of the drawer, drives to the horse track, and puts it all on a horse named Moonshot.
And his logic is, hey, I'm a genius. I know Moonshot's going to win. And when Moonshot wins, I'll put the $1,000 back. I'll keep the profit for myself or, for charity. And nobody knows the difference.
It's the no harm, no foul philosophy of banking.
Precisely. Nobody gets hurt and I get rich. It works perfectly until the horse loses.
And that's the thing about gambling. Sometimes the horse loses. The source details exactly what that money was used for. It says risky bets and highly leveraged trades.
Leverage is key here. We really need to unpack leverage because it's the accelerant. It's the gasoline on the fire.
Okay, break it down.
Leverage just means borrowing money to bet more money than you have.
So it's not just betting the $1,000 you took, it's borrowing another $9,000 to bet $10,000.
Exactly. It amplifies your wins. If the asset goes up 10%, you've just doubled your money. It's incredible.
Yeah.
But it also amplifies your losses. If the asset goes down 10%, you get wiped out completely. You lose everything.
So they weren't just betting the customer's money, they were betting borrowed versions of the customer's money on some of the most volatile assets in the world.
Correct. And the flaw in the plan, the thing that SBF seemingly ignored in all his supposed brilliance, was the reality check. These decisions only worked if the market kept going up.
It's the number go up technology.
It's a bull market strategy. Everyone looks like a genius in a bull market. When prices are rising, your risky bets pay off, you cover the hole, and you look like a wizard.
Sure.
You can move money around and nobody notices because everyone is getting richer on paper.
But markets do not always go up.
Gravity exists.
Yeah.
Even in crypto, especially in crypto.
And that brings us to section 4. The house of cards falls. The gravity kicked in.
The trigger. Prices started to fall. 2022 was a rough year for crypto prices across the board. The Federal Reserve raised interest rates, risk assets crashed, and, the party stopped.
So the market turns. Alameda's bets start losing. Badly.
And remember, the bank manager at the track, the horse is losing. Now he doesn't just have a lost bet. He has a hole.
The missing money.
The customer money is gone. It was lost on the trade. And as prices dropped, that hole became impossible to hide. You can hide a deficit when valuations are inflated. You can say, oh, this token we own is worth $1 billion, so we're good.
Right.
But when that token drops to near zero, you're done. When the tide goes out, you see who's swimming naked.
And SBF was very, very naked.
Metaphorically speaking, thank goodness. But yes, financially exposed. Completely.
So the hole is there, and then comes the leak. A report comes out suggesting Alameda's balance sheet is basically full of made-up money, full of their own tokens. The truth began to leak out. And what happens when people think a bank doesn't have their money?
Panic. Absolute. Primal financial panic.
Yeah.
The bank run.
It's a tale as old as banking itself. Doesn't matter if it's 1929 or 2022. People rushed to withdraw their money. They logged in and they clicked withdraw.
And this is a moment where the visual of the digital vault being empty just hits home. In a normal solvent exchange, if everyone withdraws at once, it's annoying for the company, but it's fine. The money is there. It's one-to-one.
But FTX didn't have it.
He didn't have it. It was at the track. It was in failed ventures. It was in Bahamas real estate. It was in political donations. It was gone.
The collapse timeline mentioned in the source is just startling. It says within days.
This wasn't a negotiation. It wasn't a restructuring over months. It was a cliff. Step 1. Withdrawals frozen. That is the most terrifying notification a user can ever get. You see your balance, you click the button, and it just says, request pending. Forever.
It's the spinning wheel of death, but for your life savings.
Step 2, bankruptcy filed. Step 3, billions of dollars simply disappeared.
It's tragic, but there is that dark humor again in the contrast. I just keep thinking about those Super Bowl ads. You have Larry David or whoever on TV telling you it's the next big thing. Don't be like me. Don't miss out.
Yeah.
And then practically in the blink of an eye, the doors are shuttered and the money is gone.
It's the safe company filing for bankruptcy faster than the risky ones. It completely upended the entire narrative. It's like finding out the designated driver was actually the drunkest person at the party.
Which moves us right into the aftermath. Section 5. The breach.
The impact was massive. The source notes. Millions of users were affected. Entire portfolios vanished.
Yep.
And we aren't just talking about rich venture capitalists losing a bit of play money here.
No.
We are talking about regular people, teachers, engineers, students who believed the marketing, who believed this was the safe way to get involved.
And the perception shift. The source says the image of crypto changed overnight. It went from the future to fragile.
That word fragile is so important because before this, the narrative was that crypto was robust. It was an unbreakable code. It was the future of finance. But FTX showed that if you introduce human greed and centralization into it.
Mm.
It's as fragile as a soap bubble.
Let's analyze the shock here, because the source makes a really, really interesting point. It says, what shocked people wasn't just losing money. People lose money in the stock market all the time.
Right. If you buy a stock in a company, let's say a car company, and they make a bad car or the economy tanks, the stock goes down, you lose money, you're angry, you're disappointed, but you aren't shocked in a moral sense. You took a risk on a business's performance.
But this was different.
This was the fragility of the system when transparency disappears. The shock was the realization that the dashboard they were looking at, the app on their phone that said account balance, $50,000 was lying.
It was a fiction.
It was a number on a screen with nothing backing it. It was like a video game score. You thought it was real money, but it's just pixels. That is a psychological violation. It's gaslighting on a multi-billion-dollar scale.
Right. The source calls it a breach of trust. And I think that's a crucial distinction. It says this wasn't just a business failure, it was a breach of trust.
And discussing the difference between a business failing and a business stealing. It's huge.
Yeah.
A business failure is, we tried to sell ice to Eskimos and it didn't work. Sorry, we are closing down.
Right. Bad business model.
A business stealing is, we told you we were keeping your ice safe in our freezer, but we actually sold it to buy lottery tickets, and now the freezer is completely empty.
Fraud.
Fraud. Plain and simple. And it's the betrayal that hurts more than the loss for so many people.
So we've watched the ship go down. We've seen the captain swim away or, well, get arrested eventually. Now we have to ask, what do we learn? Section 6, the lessons, the so what?
The source gives us two very clear, very uncomfortable lessons. Lessons that kind of hurt to admit because they make us feel a bit stupid for falling for it.
Hit me with the first one.
Trust without verification is dangerous.
It sounds so simple, like a fortune cookie. Trust but verify, but we fell for it. Why? Why do we keep falling for it?
Because verification is boring.
It is. It's homework.
It's total homework. Transparency is boring. Transparency involves reading balance sheets. It involves understanding corporate governance structures. It involves asking the tough questions like, hey, who audits you? Is it a top 4 accounting firm, or is it a guy in a strip mall in the suburbs?
And hype. Hype is fun. Hype is Matt Damon walking through a museum telling you fortune favors the brave. Hype is a stadium with lights and music and confetti.
We prefer hype because it's exciting. We want to be part of the revolution. We want to be on the winning team. We don't want to be the buzzkill actuary in the corner checking the math.
Yeah.
But the lesson here is that if you skip the math, you lose the revolution.
The source also says transparency matters more than hype, which again feels painfully obvious now. But in the moment, hype feels like momentum. It feels like truth.
Hype masks the lack of transparency. SBF was a master of generating so much noise, so much celebrity buzz, so much thought leadership that nobody noticed the silence where the audit report should have been. He dazzled everyone so they wouldn't look at the foundation. He kept pointing at the sky.
The root cause, according to the source, is actually very simple. FTX didn't collapse because of one bad day in the market.
No, not at all. It collapsed because basic rules were ignored. Segregation of customer funds,
Right.
risk management, corporate controls, a board of directors that actually does something. These aren't sexy topics.
Yeah.
They are the plumbing of finance. They're boring, but they're essential.
And the genius, the guy who was supposed to be the Einstein of crypto, failed because he ignored the plumbing.
It's the humorous take again.
Yeah.
It's like building a rocket ship to Mars, engineering the engines perfectly, getting the best astronauts, painting it gold, and then forgetting to bolt the door shut before you launch.
Oops.
A $32 billion oops.
Oh.
It wasn't complex physics that killed FTX. It was basic negligence and outright fraud.
It really demystifies the whole genius thing, doesn't it, when you break it down like that?
Completely.
Yeah.
It reminds us that just because someone uses big words, talks about effective altruism, and sleeps on a beanbag chair, it doesn't mean they know how to balance a checkbook or that they're willing to do it honestly.
So let's wrap this up. We've unpacked the ride.
From $32 billion in celebrity friends to bankruptcy and infamy. A true Icarus story for the digital age. He flew too close to the sun, but instead of wax wings, he had user funds.
But we can't leave without the final provocative thought. The source leaves us with a chilling question that I think every listener needs to sit with for a minute.
It's the paranoia check.
The question is, how many other companies look safe today? Only because no one has asked the right questions yet.
And that's the lingering horror of this whole story. FTX looked safe. It looked safer than safe. It was the gold standard. until it wasn't.
Right.
Who else is out there right now running a Super Bowl ad, sponsoring your favorite podcast, looking like the adult in the room, but is actually just betting it all on a horse named Moonshot?
It makes you want to go check your passwords and your portfolios, doesn't it?
It should. It absolutely should. Don't just trust the logo. Don't just trust the celebrity. Check the math. Or at least check if they have any math to show you.
Paranoia mixed with empowerment. I like it.
Trust, but verify. And maybe verify twice.
Exactly. Well, that's it for this deep dive into the FTX disaster. Hopefully your portfolio is safer than SBF's
I'll
reputation.
certainly hope.
We'll catch you on the next one. Stay curious and stay skeptical.
Goodbye.